In today's special program, we speak to Larry Qiu, a professor at the School of Economics and Finance at the University of Hong Kong, about the yuan appreciation and China's exchange rate reform.
The spot yuan rate closed at 6.1192 against the dollar on August 7. That's the highest since the country unified the market exchange rate at the end of 1993. And its appreciation does have repercussions.
I think it does have a big impact because China, the Chinese economy is an export-led economy, and about 30% of the export is about 30% of the GDP, and which is very high. And so once you have this RMB appreciation for whatever reasons, Chinese export will be reduced if this is the only case. And then that's going to affect the export, it's going to affect the employment a lot because the exporting sector in China is the labor-intensive industries, right? So it's going to have a big impact on the employment in China.
The record high level of the yuan spot rate has triggered speculation that the central bank is testing the waters for an imminent move to expand the yuan's trading range. In April last year, the People's Bank of China widened the yuan's trading band against the US dollar to 1% above or below a daily reference exchange rate from its previous 0.5% limit.
If the government keeps on having a tight control in the exchange rate market, and it will not. But I think the direction is to make the exchange rate more flexible, the regime more flexible. In that sense, the fluctuation will be larger in the future. And this may not be bad because in the market, actually, there's a fluctuation in the market, the exchange rate should also fluctuate.
The State Administration of Foreign Exchange says the country will steadily advance convertibility under the capital account. Qiu suggests Chinese authorities should allow yuan funds to move more freely in and out of the country.
First, you should open your capital account, allow capital free mobility across the borders, and allow capital to move in and out freely. And this is one thing you have to do. The second thing is that the domestic money market reform, liberalization, like the interest rate marketization. And these are the two things you need to do.
Qiu points out that as China gradually relaxes its capital account control, it could pose some uncertainties to the domestic economy.
And if you look at the capital account, openness of capital account, when you allow capital to move in and out without controls, and this is going to have a huge impact on the domestic economy. Sometimes you see a large capital flux into the country, and sometimes you see they leaving the country and to a large amount. And this is going to create a large uncertainty to the domestic economy, which is China doesn't want to see. But again, China has already moving towards this direction step by step. For example, allowing more this QFII, QDII to move the capital in and out of the countries. And also China is the second largest economy in the world. And being a large economy and such types of fluctuation or increase or decrease in the capital inflow and outflow will not be a big problem for a large country. So this is a problem, but it's not the biggest problem.
Concerning the country's exporters, China's top economic planner, the National Development and Reform Commission, says the country needs to keep its currency exchange rate stable in the short term. But Qiu says in the long run there's no need to worry about exporters as they will adapt.
But I don't think this is a big problem anymore. It was a problem in the past, and because exchange rate appreciation, RMB appreciation and fluctuation is bad for exporters. But the Chinese exporters have already learned in the past 8 years about how to do business when you face the exchange rate fluctuation, and how to do business, how to increase your competitiveness when the RMB becomes stronger and stronger. But if you look at the overall picture, and even though the Chinese currency has appreciated by 26%, but China's export is still growing very fast. And so that means we don't really have to worry that much about the impact on the enterprises. And the good thing is we have been given them a long period of time to make an adjustment to learn how to play in the world market.